Welcome to Annuity Speak and Annuity Speak TV. I'm your host, Dean Lovett, and I thank you for taking time to watch this episode entitled Review of a Liberty Life Insurance MYGA Annuity. If your desire is to lock in a fixed interest rate for up to 6 years at a higher rate than today's CDs while deferring taxes on those earnings, you should consider the Liberty Life Company 3+3 Master Annuity. Most importantly, as always, the insurance carrier offering this product, Liberty Life Insurance, is financially strong and rated A for excellence by AM Best Rating Services. With regard to MYGAs, or multiple year guaranteed annuities in general, they aren't especially appealing in today's low interest rate environment. However, if you have money which you may need to access in a few years and don't want to take any risk in today's fragile financial markets, a MYGA offers tax deferral for your interest income and complete safety from market risk until you need your money. The guaranteed 3+3 Master requires a minimal premium payment of $10,000 and offers a guaranteed interest rate for 3 years or 6 years, depending upon your preference. As of this broadcast, the guaranteed 3+3 guarantees an interest rate of 3.75% for years 1 through 3 and 3.5% for years 4 through 6. For whatever years beyond the 3 or 6 for which you locked in your rates, the guaranteed 3+3 will pay you a minimum interest rate of 3%. Depending upon market conditions, that rate could be higher. Like all annuities, the guaranteed 3+3 offers you a variety of ways to withdraw money or have it paid out to you over time. Withdrawals are available as follows. After the first year, you can annually withdraw up to 10% of your account accumulation value without penalty. Number 2, if you elect the basic contract with a 3-year guaranteed rate, you can withdraw all your funds after 6 years without penalty. Number 3, if you elect the option to guarantee a specific rate for 6 years, you can withdraw all your funds after 9 years without penalty. Additionally, you can elect to annuitize your account in the following ways. A, by specifying a fixed period of time. B, by specifying a fixed amount to be paid until your account is exhausted. C, by selecting interest income only payments. Or D, by selecting lifetime income payments for an individual or for spouses. The amount of lifetime payments are based upon life expectancies made in actuarial forecasts. You can begin annuitizing your account anytime after the first year. However, if the payout period which you specify for your annuitization is less than 6 years, then withdrawal or surrender charges would apply. With regard to death benefits, it is always critical that you clearly designate beneficiaries for any annuity in the event of your premature passing. If spouse is in a joint policy, upon the death of one spouse, of course, the surviving spouse becomes the primary beneficiary. If all policy owners pass, then the designated beneficiary is entitled to receive the accumulation value remaining. Beneficiaries may choose one of several payment options. Number 1, they can take a lump sum payment immediately upon the passing of the annuitant. Number 2, they can elect to take a payment within 5 years of the passing of the annuitant. Or number 3, they can elect to receive payments over a specific period of time up to the life expectancy of the beneficiary. Finally, a market value adjustment is made to your account if you withdraw more than 10% of the accumulation value in a given year. So, when you make excess withdrawals, if interest rates are higher than at your time of contract, the market value adjustment will decrease your account value. If interest rates are lower than at your time of contract, the MVA adjustment will actually increase your account value. In conclusion, the guaranteed 3+3 Master is somewhat similar to a CD, except you can defer taxes and obtain a higher interest rate, which is locked in for either a 3 or 6 year period of time. I understand that this can all seem very confusing, and I encourage you to pause and read the overhead text whenever necessary. I suppose the most critical issue with all annuities is really this. When you sign your initial contract, you are specifying the period of time for which you would like the annuity product to create earnings for you. So while you can always access up to 10% of your money each year without penalty, any amount beyond 10% may be penalized depending upon the time period specified in your initial contract. So your challenge is to read very, very carefully all language pertaining to early excess withdrawals and to understand what charges you will incur should you need excess cash prior to the initially agreed upon contract period. With annuity contracts, they can always be undone. The question that you must answer for any specific contract is, at what cost? So please consult your legal and or financial advisor before making any decisions with regard to annuities. And note the disclaimer on the AnnuitySpeak.com website. Finally, come back next week and check out the next annuity product review. God bless you and have a great day.